Good evening, all the joinees. So, today we have a guest speaker who would be taking our session. So, I would be welcoming Mr. Ritesh Pathak, who serves as the Executive Group Vice President and National Head Retail Sales at Motilal Oswal AMC. He brings over 20 years of expertise as a financial service leader, having specialization in areas like mutual funds, alternate investments, retail distribution, and strategy. Before joining Motilal Oswal AMC, Mr. Pathak had held senior leadership position at both Axis AMC and ICICI Prudential AMC. So I welcome you, Mr. Pathak. You can take over the session.
Thank you so much. Very good evening to all of you. And thanks for inviting me here and happy to talk to all of you. Today, I'm going to talk about a very interesting topic, which I believe at times is the sole reason why somebody makes a lot of money in the market and somebody don't. And this is something which is very, very integral for the investment part for each and every individual. And what I'll do over the maybe next 20-30 minutes, I'll take you some of the points which I have it on it. Just allow me to upload it. Yeah. So, like I said, this is something which is all of you would know, but still people make mistakes, and that is behavioral biases. So, what is behavioral biases? Uh, you know, in our investment journey, at times we are tested, and in those moments, if we get impacted by some of the behavioral things, and we do an action that impacts our journey of wealth creation. So let me take you in terms of what are those biases, how it works. So for example, for any investor, you would see that they have a journey where when we buy, when we see the market, let me put it that way, and we see markets are going up, uh, you know uh, we believe that okay, let's wait and watch the trend, and market might fall down, and what happens that market continues to goes up, and after a while, what we do is that we tend to invest our money at the at a high point. What happens after that? We have seen multiple times that market comes down, and our first thought is that market will go up, so let me wait. Then market comes down a little bit more, and we believe that let me add some money, and we could see multiple such rounds where the market keeps on coming, let's say down, and at some point you say okay, let me get out of the market. Example 2018, 2017, a lot of people came in mid and small cap. 2019, market started correcting. Some people did averaging. By 2020, a lot of people thought, okay, I made a mistake. Let's get out of mid and small cap funds. Okay. And that became the actually bottom of the market. And what we saw after the, let's say 2020, the mid and small cap actually delivered a lot of returns to the client, right? And what happens that then once you are out of that, let's say your investment, and you see, market moving up again, and again you talk about okay, it will fall down, I will not invest now, and again you get to same trap of the entire market chain. So point is that as an investor, you have to manage your emotions. It basically means let market will move in a roller coaster kind of a moment, and you have to stay invested for a longer period and not get impacted by the market, and especially do not redeem the money at the bottom. For example, I'm seeing a lot of people now are asking me that should we invest the money now because last 1 year money has not been made. I'm saying that's a great thing. You have not made the money. It's a great time to invest. So people tend to get biased in multiple ways while making the investment decisions. Now, what is the difference between investor return and the market returns? Right? Market returns is what market delivers, and investor return is something investor get. Now the gap between the two is basically because of the investor behavior and biases, which we'll talk in detail. But if you have to understand, is because of two reasons. One is cognitive bias, and what is emotional bias. Okay, emotional bias is that it comes out of your feeling. I believe market will come down. I feel that market will go up. Cognitive biases. You use data as the to have that bias and then make decision based on that particular faulty data. that is cognitive bias. So we'll talk about both these biases, emotional and cognitive biases, and what are the biases that comes out of these two major biases. So if you have to divide multiple biases, these are some of the very, very common biases which we see in the market: confirmation bias, loss aversion bias, recency bias, overconfidence bias, herd bias, and anchoring bias. What I will do, I just take you through one by one about all these biases. Let's understand the first bias, which is confirmation bias. Now, confirmation bias is basically is our beliefs. You know, uh, we have a belief, and whenever we see a data, okay, we use that data to further confirm that what I have thought is the correct thing. For example, you believe markets will come down, and you see some newspaper article or something on the TV which is supporting your thoughts, and we suddenly built our whole decision based on those confirmation biases, and data which is not aligning with your biases, your mind actually exclude that, right? And that is what we happens in a confirmation bias. We ignore the facts and evidence, and we basically move by the our emotions, our beliefs, which we believe. For example, a lot of clients I met today, met in last few months, are telling me, sir, markets will not go up. Markets not given any return in the last 1 year. Should we put money in equity? Should we transfer the money to, let's say, uh, maybe FD, or we transfer the money into somewhere else? So problem is that you are basing your decision based on beliefs and not on facts and biases. And this is the very, very common bias, which is a loss aversion bias. So what happened in this, that you are so fearful of the failure that your decision making is based out of that. So let me give a very simple example for this. Now, a lot of people do fixed deposit. And when we ask why you're doing fixed deposit, why not equity market, they say, sir, what happens, the market में तो ऊपर नीचे हो जाता है, गिर जाता है valuation, right? Now, their fear is that in the short term, there could be a volatility in the market. So they are fearing that when they invest the money will come down, and they are ignoring the fact that for decades, 5 year, 10 year, 20 years, or 25 years, 30 years, markets have delivered almost in excess of 10% compounding returns for the client, right? So you are influenced by the negative bias on the investments. Okay, so your mind is basically telling you, you have a failure of the you have the fear of failure, and that is much more important or higher than the benefit of success. A lot of people who invest into the fixed deposits are basically are have this kind of biases in their mind. One more thing you can add to this is that the pain of gaining 1 rupee is more than the pain of losing 1 rupee. Now, if you understand, losing 1 rupee and gaining 1 rupee is similar, but the pain which comes from losing 2 rupee, 1 rupee, is much higher, and that is what the fear of failure is all about. Now, third is anchoring bias. Now, this is a bias basically you have based on few data, you believe this is what will going to happen in the future. Okay, so for example, what we see that in FY21 and 22, market delivered very good returns. Okay, so as an investor, you said, oh, and a lot of people which actually came to market after 2021, they don't know that market actually are volatile, and they aren't supposed to give you returns every year. If that happens, then I don't know what your returns on the market over a decade or so. That doesn't happen anywhere, right? Not in India, not anywhere else. So people who invested in 23, in looking at the term 21 and 22, they believed, okay, 21, 22, people have made good money. I will also make good money. But that year was a very, very flat year. People did not make money. Okay. So basically, anchoring bias is nothing of cognitive bias, the database bias, which comes where you are basing your entire decision on the first piece of information you are getting, and you are primarily focused on that only. Again, this is for, like I told you, last 1 year returns have not been made. So a lot of clients are telling me today, यार Ritesh, returns have not been made. तो अगले साल भी पैसा नहीं बनेगा. It doesn't work like that. That's why markets are very, very interesting. So the chances of probability of market doing well in next 1 or 2 years is way, way higher, because the market has been flat in the last, let's say, 12 months. So today I'm seeing more people are basically, looking at the anchoring bias, also recency bias. Yeah, that's the next bias, recency bias. Recency bias is nothing but a short-term trend multiplied in your mind to take a decision for future. For example, you're saying the last quarter or 2 quarter money has not been made, and you are saying that this will continue, or just like for example, uh, if you look at this chart and you see that 2021 between October to December, market corrected by almost close to 1,500 points, roughly 10%, and your mind will say, okay, this may happen in the future. Also, if you base your data on this or update decision on this, so you see 21, 22, 22 uh, Jan to March and 22 March to June. And when you see market are moving the same trend, and you thought, okay, I think this will what will happen in the future. But in July 22 onwards, market has actually moved up, right? So you thought, okay, this is what happened in last 2, 3 quarters. Market may remain in a particular way, but market has actually worked in a different fashion altogether. So recency bias is something which makes you take a lot of wrong decisions. For example, a lot of people believe that IT as a theme will do very bad because last 2, 3 quarters IT as a theme has not done well, or it has gone up, it has gone down after that, very, very soon after that. Again, I think, but it doesn't happen that there could be a possibility IT can do well from here. So don't be biased too much on the recency thing. It is absolutely one of the very, very common biases which we see when I meet clients on the for the investment side, right? Let's understand next bias, and this is something to do with overconfidence. For example, let's say you're thinking that you are better than everybody else. So, for example, in Americans, 65% of American think they have a better average intelligence than the others. 65%, imagine, right? 73% American think they're better drivers than others. So this is a very, very high proportion of people are very, very confident about, or not confident, but overconfident about their abilities, etc. And this happens when you put so much of faith in your own understanding and knowledge, and you are saying that what you believe is the right thing, what you know is the right thing, and you are not ready to understand or ready to believe that yes, what you may know may not work out in the future. So overconfidence bias is something, मुझे पता है market में क्या होगा, market यहाँ से नीचे जाने वाला है, you know or somebody says, I know market will actually going to move 20% from here. So people are taking extreme views here because of overconfidence. Now, herd bias, this is, I think, the most common bias in India and the world, where you invest where the others are investing. For example, everybody comes to me and says, sir, we want to invest in gold and silver. What do you think? Because a lot of people invested in gold, or maybe their neighbors have invested in gold, or somebody has told them they invested in gold and made money. So you are saying, since somebody else invested and they have made money, I will also make money. Let me a part of the crowd. सब लोग डाल रहे हैं पैसा तो अच्छा ही होगा. No, it doesn't happen that way. The herd mentality is nothing. You just copy the others, and you believe what others are doing, you should also do it. Since the majority is doing, that is the right way of doing. No, it doesn't happen that way. So today, I tell you, I believe that in India, a lot of Indian mutual fund portfolios have very high allocation to IT services, banking, etc. in the portfolio. I always tell our investors and partners that what happened in IT services, what happens in some of the large private banks will not happen in the future. You will have new set of teams doing well. Many manufacturing, digital companies will do well. In consumption instead of FMCG, maybe the discretionary company where you spend money for a hotel, etc., will do well, right? But not a lot of people are of that view. They are still believing that what has worked in the last 2 decades will work. That comes from the recency bias. अरे पिछले 10 साल में तो बैंकिंग फंड में पैसा बना अभी भी बनेगा. So you as an investor should not follow the crowd blindly. Have your own thoughts on that. Take the advice of the if you do not have the expertise, take the advice of the uh, advisor or a partner. But be aware of this herd mentality. It's a very, very common bias across the world. Now, let me give you some data to show you talked about some of the biases we just spoke about. Every year, the best fund ranking changes. People tend to chase the best fund in the market. But the fact is that your best fund after 3 years may not be the best. Look at 2000, let's say, let me show you, let me put a pointer here. 2013 and 15, look at the top 2, 3 funds, look at the ranking after in next 3 years. Because people chase the best performing fund. You chase the best portfolios, right? You should keep a portfolio where you have all the styles in the investment, a value style, growth style, and not chase fund just because something has done well in last 3 years. You expect that to do well in the future. Again, recency bias, right? So be very, this doesn't happen, and do not base your investment decision just because some fund has done well in the past, they will do in the future, and 90% of time that doesn't work. Let me give an example. These are the sector-wise rotation in terms of winner. And you see, for example, IT 2015 was the second best category. And after 2016-17, they're the bottom categories, right? Reality was a top category in 2017. It was a bottom category in 2018. So sectors rotate, assets rotates, same in equity, that also happens. And look at the data but this is data for last 5 years at the end of every year. Data of 5 year, end of every. So you see that if you are investing in 5 year, you are actually, so for example, let's say I take a very bad example, 2013, somebody in December would have thought my 5 year returns is just 1%, because the market will corrected extra. But if the person would have remained invested for 7, 8 months more, returns on the total investment will be 17%. So market reward you for longevity. Market always, will do a bounce back. So never ever redeem money at the bottom. You should always go aggressive if you have provided your money to invest in the market equities if the markets has not given money in the recent past. So this data shows that every 5 years your average returns is close to 15%. Despite that, people tend to, we have only 5 crore invested in mutual fund in India. Only we have just, 4.8% savings go to equity in India versus 70% in America, 49% is America, and all the our neighboring countries, the equity portion very high. As an Indian, we are still evolving and trying to understand the equity. So why it is important? So you have to understand the power of compounding, right? So we talked about that. Don't be biased in terms of cognitive and emotional things. Okay. So what are those things now? Now we understand the biases, recency biases, loss aversion biases. So avoid that. The only way is to remain invested for a long period, right? And the success is very simple. 1% vision, where you want to be. I want to buy a house. For that, I need X amount in 10 years. This is my SIP or lump sum investment. I will remain invested. 9% of wealth creation happens through execution. That you are not making mistakes of, leaving the bottoms of the market to invest. You invest in those period, right? You do not take out the money at the on the bottom of the redeem. Don't redeem at the bottom of the market, right? So execution is important. You should be able to put money when the opportunity comes. But the 90%, which very few people have, and because everybody become the expert matter of the mutual funds and equity, uh, is the patience. So 90% money is made through patience. And I think this is one thing, I have seen in the people least. I've been in industry for 21 years. Now somebody invested 6 months back is coming to me, says, sir, your fund has only delivered 5% return. Index has delivered 6% return, right? Equities investment is of 5 years. Okay. Motilal Oswal portfolios have delivered huge alpha to the client, but it cannot be delivered every month and every quarter, right? So patience is important. If you're sure where you're investing, if you are convinced by the style of investment, you're convinced by the way of investment, then remain patient. But 90% of success will lie on the patience part, right? Vision is 9%. Execution is also very low, 9%. Patience is the key thing. Okay. The answer is that you don't have to be smarter. You just have to be disciplined. So it's not the IQ, it is the EQ which is more important. And as the header of this slide says, your returns are made 80% through EQ, IQ is only 20%. So any average client, every average investor can become do a wealth creation as long as it is able to manage the emotions very well and remain patient in the long term. Now, the first thing we talked about is vision to see. How to make money now? The first is vision to see. We talked about your vision. Let's talk about vision. What is vision to see? Vision is that where you want to be in life. Data is slightly dated. I made this data around 1.5 years back. I'm using this. Actually, it's a 2 year, 3 year back data. But the point is that if you see this data, equity has delivered 7x more return since 2000 and let's say 79 uh, compared to gold fixed deposit, which basically mean, if you invested 100 rupee, your money would have been close to 46,000 in equity and 6,800 in gold and 6,000, 3,000 odd in fixed deposit. So your returns are primarily happens, calculation happen in long term, and always understand the formula. If you're making 6% through, let's say, an FD, if the inflation is 6%, you're making 0% return. Okay, so if you keep 100 rupee in your cash in your pocket and you don't use the cash for investment, you have lost money 6 rupee through inflation. So you have, when you make investment, you have to look at real return. Real return is total return minus tax minus inflation, right? So if you, let's say, invest in a fixed deposit, you make 6.5 7% return. You have to pay, let's say you are in the 20% tax bracket, you have to pay 20% tax on 7%. You made 5.4% return. Inflation is 6%. Your real return is negative 0.06, right? So if you really want to create wealth, then your returns has to be positive in terms of real returns, minus tax and minus inflation. And like I showed you, inequities, if you look at the return for 10-year, 15-year, 20-year, 25-year, 30-year, 35-year, the returns are 15% plus positive for the index, and funds have delivered much more. For example, our mid-cap fund had delivered 12x return in last 12 years, or 11 years, sorry. So client have made almost 25% CAGR return, 24% CAGR return on that fund for last 10 years. So that's the power of equity we are talking about, right? So vision to see is very important, where you want to be in the long run. This is just the example I was trying to tell you. If you look at a fixed deposit return, post-tax return is lower because of the tax part. Inflation 5%, you made only 1% return. In equity, let's say 15%, post-tax 13.5%, inflation 5%, you made almost close to 8.5% return, real return, right, over the inflation. This is almost negligible in case of the, let's say, FD. If you are making money at 1% real return, it will take 70 years to double the money fixed deposit. It will take only 8 years in the equity. Okay, in terms of real return. Courage to buy. This is a second important thing. So, like I said, people don't like to invest when the markets are down. Actually, that's the best time to invest in the market. Uh, Also, I have seen people don't invest first. They look at all the expenses they have, and whatever is left, they invest. Or that's a wrong formula. You have to, from your income, you have to minus the expenses. Okay, sorry, in your investment, in your income, you have to first minus the investment, and whatever is left is your expenses. So always remember, you should know what is investment amount you have to put, and what is left, and then you have to spend the money, and not the vice versa. Otherwise, if you keep ignoring investment and investing only what is left after expenses, then the whole wealth creation can take hell of a time. And Warren Buffett says, you should be greedy when others are fearful. You should be fearful, others are greedy. Today, people are fearful. I think it's a great time to be greedy. But very, very few investors agree to this. But, Warren Buffett said, I have personally seen him multiple times in my life. Whenever the market not made money in 1 year, a fantastic time to put money in the long term. Like I said, Warren Buffett always says, do not just be disciplined and don't have to be smarter. And third, but the last, is a patience to hold, which very few people have. And this is where the wealth creation happen, right? Now, let me show you the chart. Now, on a 25% CAGR return, okay, in 10 years, okay, let me put it away. In 5 years, or 3 years, your money is doubled. Let me put it this way: 3 year money is doubled. In 10 years, your money is 10 times. But in 20 years, money is not 20 times, your money is 87 times. There's a power of compounding. Okay. Similarly, in 30 years, it's not 160 times, it is 808 times. Right? Now, that's the power of investment. Right? 808 times. Now, imagine you are making 10% return, which means that in 30 years, we are making 17 times. Now it's up to you. You want to make 17 times in 30 years? You want to make, let's say, 20 times. Okay, even this is possible, to be honest. And like I told you, some of our funds are able to deliver that. Now, look at this. This is the formula of the compounding, which is, you know, amount you're investing, principal, multiplied by the rate of return, multiplied by T. Now, every investor is focused on how much return I will make. The great obsession of everybody is the return, but what people ignore is the time. As an investor, what is in your control? Is it a time or the return? What's in control is the time. I think time is the most important thing. And if you are able to hold uh, your patience and continue remain with for long term, so compounding can be anything. This is a very good data. It shows that time in the market is the main thing which create wealth and not timing the market. So, for example, this is Nifty 30-year data. Okay, it shows that if you invested in Nifty, your money would have been grown by 54 times, right? But if you missed the, you know, best or missed 10 best days, out of which 4 days came best days, out of those 10 best days came in the bear market, your returns would have fallen from 54 times to 19 times. And if you miss the best 20 days of the market, again, these 20 days came in the bear market, 12 of these 20 days, your return would be 9 times. And if you miss the 30 days, okay, out of which 19 best days came in the bear market, returns would be 5 times. So now, do you want to make 5 times, 9 times, or want to make 54 times? A lot of data is available in the market, which shows that the investors always earn lower than the fund. And it is nothing. It is only the difference is the emotional bias. Try to predict the market, try to get swayed by the what's happening in the industry, newspaper, television, and taking decision that yeah, I made money, I invested money, this fund has not done well. Now let me take out the money. The fact is that maybe the next one is a turnaround period. So you have to remain patient, long term, and take advice of the financial advisor to understand if you need to actually move out. There's something fundamentally wrong with the fund, then you can get out of fund. But if not fundamentally wrong, the fund is fine and it's only because of the market condition the fund has not delivered, then you may remain patient and remain invested for a longer period and your experience will be much, much better. So this is the person we all admire, Mr. Warren Buffett. And look at this compounding. Now, he started investing very, very young age. He was around $25,000 age of 30. By the time he became 60-year-old, his money multiplied from $25,000 to 11.9 million, almost $12 million. And that's because of compounding, because he compounded at 15%. His compounding is not more than that. His compounding only 15%. And also remember, that Warren Buffett, during has been 77 years in the market, right? In this 77 years, because he started investing very, very young in terms of it, 13 years, market has multiplied by 5,288 times. But the CAGR is just 12%. Now that's the magic of compounding, right? Gold has multiplied by 37 times and fixed income by 89 times. Point is limited that equity delivers lot of money to clients through wealth creation in the long term. The only thing between you and the wealth creation is the behavioral biases, your emotions in between that. Remain very, very consistent with your emotion. Focus on discipline. Focus on EQ. Don't focus on IQ. Don't try to redeem at the bottom. Don't try to mix opportunities when the market gives you in terms of investment, and your journey will be far, far superior. And last is our own founder, Mr. Ramdev Agarwal of Motilal Oswal AMC. He started in 1987 his business. At the end of 1990, his wealth was 1 crore. Today is at 3,000 crore. And at every market correction, his wealth came down, but he remained patient, he remained consistent, and the only one place he invests in life is equity. Because he believes that beyond equity, there is no other place where you can actually multiply the money. So there's a live example. Warren Buffett is of America. This is an Indian example for your understanding. And now his total wealth is now more than 3,000 crores. Thank you for your time. I hope I was able to share some insights with you. If there are any more questions, really happy to take any questions from all of you. Thank you so much. You can put your questions in chat. I'm happy to take, or you can unmute and you can ask. It seems that everybody is understood that the only way to make money is basically remain disciplined, manage your emotions better, don't get swayed. Actually, uh, so Ajay Gupta is asking me, any good book to read on this. So there are a lot of multiple books uh, to read on the behavioral biases. I think they do one book. I think a lot of simple books are available. There is nobody has authored a book basically on investment biases per se. But what I'll do, maybe I'll just do a quick check and maybe I'll inform the Anshu to the NGEN team and she can forward to you. I think I can share you some names maybe by evening today so that you can go through. Thanks a lot for the question, Ajay. Okay, let me see if there are any more questions. I don't see. So anyway, so my parting thoughts are, be future oriented. You will see a big change in India in terms of new themes. The entire India is moving from a economy which was not manufacturing oriented to a manufacturing oriented economy. Digital will play a very, very big role in India. Just like in US, Nasdaq delivered 5x more than Dow Jones as an index. I think in India, digital companies will deliver a lot of wealth to the client in the long term. And I think that's a great place to be in as a theme. That's a fantastic theme. We also have a view that consumption will do very well in India. Again, discretionary consumption, not staple, not FMCG, but when you spend money, the per capita of the India is $2,800. We will be close to $5,300 by next 5 years, which means that more money in the hands of investor and the consumers, and they are going to spend the money. Fourth theme where I think India will do very well and people will have a very good wealth creation is the capital markets, which I'm also part of. Mutual funds, exchanges, depositories, KRAs, broking houses, wealth companies. I think in India, equity is still very nascent. Like I told you, only 5 crore mutual fund investors. I believe the number of investors could be in excess of 10 crores in maybe 5, 6 years, which will double in what we have done in last 20 years, may do in next 5 years. More people will transit in equity through demat accounts. Beneficiary will be the capital market companies. SIP is only 28,000 crore. I think it has almost tripled and quadrupled in the last 6, 7 years. It will grow even further. So capital market as a theme is very, very strong theme in India, which I can tell you. And as an AMC, Motilal Oswal AMC, we focus on these themes only, and we follow growth style of investment. So if you want to look at Motilal Oswal funds for investment, so we are AMC focused on investing into companies which are high on profit growth and on newer themes and not the themes which are played out in the past. So our portfolio will look very, very different than any other fund in the industry, mostly 90-95% different from any other fund, which you will find in the market as such. So I think no more questions. I mean, thank you all of you for the time. Really thank you for the NGEN team for giving the opportunity to speak to all of you. Have a fantastic evening and thanks for coming on this session. Thank you so much. Take care. Bye-bye.
Sure. Thank you, Mr. Pathak, for hosting today's webinar. It was indeed an informative session. We really appreciate you taking your time to share your advice on the topic today. Thank you so much.
Thank you so much. Have a nice evening. Bye-bye.
Sure.